Hello, welcome, and we're so glad you're here with us today. As you're coming into the webinar room, I want to welcome you. My name is Marche. I'm the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We are so excited to bring you this educational presentation today. A couple of items that attendees will need to note. You are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the webinar today during our question and answer portion. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well, and we'll reach out to you after today's event to make sure that question gets addressed. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our speaker today. Mark Seither is a partner and wealth manager with Kingsview Partners in Knoxville, Tennessee. He has a Bachelor of Arts in Economics from San Diego State University and began working as a financial advisor in La Jolla, California. Mark enjoyed finding innovative solutions to his clients' complex problems, and his desire to work with the entrepreneurial-minded helped him thrive as a financial advisor. As Mark honed his skills as an advisor and planner, he looked for a platform that would better pair with his desire to work with clients needing advanced planning and specialized fixes. He found his spot back in Northern California in early 2017 when he joined Trust CFO and assisted in integrating complex tax and estate planning with wealth and investment management. Since then, he has collaborated with Josh Saunders to build Kingsview Partners, and together they assist individuals on wealth management and tax strategies. And we are going to be talking about taxes today and strategies, and I'll go ahead and turn the time over to you, Mark. We're glad to have you back.
Thank you, Marche. Glad to be back, and glad that we have this many people who are excited about nerding out about taxes. I could not think of a better way to clear a party than to say, like, hey, what do you think of the recent tax code changes, or what's on the docket for tax code changes. So having this many people, awesome. And to just touch on one thing, my business partner and I, we both have an asset protection background where, you had mentioned working at Trust CFO, and we did work with a lot of businesses and successful entrepreneurs. And one reason why we just dove really hard into this tax topic is because when it comes to growing wealth and preserving wealth, tax strategy is really the cornerstone, right? And if there's a lack of planning or just a lack of knowledge of how things can get out of hand and you're stuck in a tax disaster, that's what we call a bad day at the office, right? And so we really try and get people to look at, like, you don't have to be a business, but if you build wealth like a business owner, if you build wealth like a business, taxes has to be a very, very key part of the conversation. So for everyone who's excited for this, one thing I will say is, often when we get introduced to people, we will look at, okay, here's why taxes matter. We'll look at what they're doing and we'll say, do you have a retirement plan for saving for retirement, or do you have a retirement plan, right? Do you have a retirement savings plan or just a retirement plan? Now, our retirement savings plan is pretty simple. I'm deferring money to my 401k, saving money to an IRA, right? And I've done the calculations and I know it's going to be worth X amount. and I'm just going to spend off that, right? That's a savings plan, and it's very easy to do. A retirement plan is, how am I going to get that money out, right? If you just say like, well, I just, ask for the check, right? That's not a plan, right? That's, and we can get into why that is. And really it comes down to, you have a limited flexibility of asset taxability, right? You are much more vulnerable to either changes in your life that require more capital, swings in the market that, maybe deplete your resources, or just a change in the tax code. We already know that it's going to change in 2026, right? And so if we're not accounting for those things and saying, hey, how flexible am I in my taxability of my assets, we're going to run into trouble.
We did have a question here, Mark. The question was, how soon should you worry about tax planning in your retirement plan? Let's say if you're a young professional, is that something really to worry about yet?
Well, I would say yesterday, right? And that's not just a cheesy line. The longer of a runway you give yourself for dealing with these issues, the more planning can be done, right? And there's going to be things I talk about today where I even say like, hey, this is likely not something you have to do tomorrow. It's something that we at least need to be educated on, right? So that we can be aware of, and I'll go ahead and just tease it. It's the inheritance tax, right? As we'll get to that point, I'll dive, I'll only spend about 30 seconds on that slide. But it's really about like, hey, this is an issue for this group of people. That doesn't mean it's always going to be that group of people. And here's the things you got to know if you want to get around that. So, okay. If we go to the next slide. So poor tax planning erodes wealth, right? And part of that is because, it's kind of funny. I will sum this up to people by saying like, well, the reason why you're unaware of your tax drag on your wealth is the same reason why humans are addicted to sugar, right? We like what makes us feel good, right? Seeing tax inefficiency doesn't make us feel good, so we tend not to focus on it, right? Now, some people aren't wired that way. And they like Brussels sprouts and they're weirdos, right? I'm more of like a bacon wrapped Brussels sprout guy, but for most people, it's not really a focus point. But there's a little bit of financial psychology that goes on here too, where if you have a $500,000 account and you have a good year and you make 10%, and now you have a $550,000 account, you're happy, and you should be happy. Because that's $50,000 you didn't have before. And like that, just as an example, that makes me happy, right? But if you just look at your account and you just look at the growth and say like, sweet, I did good, and you put that to bed, and you don't look at any tax drag outside of that account, right? And we'll just say that you had a poorly planned event or some tax inefficiencies, and you ended up paying $25,000 in taxes that you did not need to. The lack of awareness of that issue is bad enough. The ignoring the issue because it's painful is like far worse, right? But it's what happens so often because, again, we're addicted to sugar. We like seeing like, well, no, I don't care about the 25,000 I lost. I made 50, right? I want to focus on what I did right? And so we really just try and get people to, say, hey, if you want to build wealth like a business owner, these are the things that you have to address, and it's going to help accelerate, success moving forward. And it's going to also help you avoid what I call the tax deferral trap, which is, I'm not saying don't defer money. I'm not saying don't defer taxes. It's a great way to accelerate wealth. But if you hit retirement and you've got a $4 million 401k or an IRA, and you don't have, right? Let's say you had a tax savings plan, but you didn't have a retirement plan. And
you mean a retirement savings plan, not a retirement
sorry.
plan. Yeah, I think that's what you meant. Yes,
if you have a retirement savings plan, but you didn't have your actual retirement plan, right? For how you're going to spend that money. Well, there's really no way to know, okay, of your $4 million, whose is the IRS's, whose is the, how much does the state get? Any creditors right now? If you know the nuances of the qualified space, you might be like, well, there's creditor protection for qualified plans. It's like, yes, except for after it gets inherited. And also like, okay, let's say they take your house, they don't take your 401k. Well, now you got to spend out your 401k to go buy a house, right? So I mean, there's just there are things to think about in that regard.
Okay.
And where this comes into play really is, we had an experience earlier this year where someone had a $25,000 emergency, and there's no real way around it, and they were in that tax deferral trap. And so it was, hey, I need $25,000. It's like, okay, well, in order for us to get you a after-tax number of $25,000, we actually have to sell $40,000 worth of investments, right? They did not like that news because they're already mad about the $25,000 emergency. Luckily, they weren't in this circumstance, but you could also imagine if that $40,000 was after a pretty big loss in the account.
Oh,
right?
you mean if the market's down?
Yeah. To just break it down to easy math, right? Let's say it was like, okay, well, we had to sell 100 shares to get $40,000 to give you $25,000.
Right.
Well, if 6 months earlier those 100 shares were worth $60,000, now you're looking at like, holy cow! In 6 months, I had this many shares that used to be worth 60, and now I got 25. That's again what we call a bad day at the office.
Yeah.
Right. So that's a part of the tax deferral trap, and the other part is, and this is one of those, for that person who's asking like, hey, how young is too young to start planning? For people who have a nice healthy retirement account and they have that $4 million and they think, okay, well, I have $4 million in that account, I'm going to spend it at 4%, right? That's 125, it's 120,000 a year. I'm happy. Well, at a certain age, Uncle Sam says, we've waited a long time for your tax deferred money, so we're going to tell you what you pull, right? And that's called a required minimum distribution. And at the end of the year, you get you have your CPA or your wealth manager tell you like, okay, well, you need to make sure we spend at least this amount, so let's take this distribution. Well, to play this into a hypothetical scenario in which you could, that tax, that $25,000 of unnecessary taxes could really come back to be a real thing. You could be looking at, okay, well, what if the government, like, I need 120,000? What if my RMD is 180,000?
Right.
And
so you have to withdraw more than you actually need.
Exactly. You have to withdraw more than you actually need. And let's say you didn't set up some proper tax planning, but you did set up some other prudent planning. And you're like, well, I need 120,000, but I'm making 40,000 on this passive investment over here. So I actually only need 80,000. Now we're looking at a huge swing between what's in your account and what you need to pull out. You could very easily be looking at a six-figure number of them saying like, that's great, you don't need this money, but we need the taxes from that money. Take it, pay your taxes. We don't care what you do with it after that. I mean, hopefully put it in something that grows so we can tax you again. Right?
Something that's not tax deferred.
Yes. And so that's really where you need to start looking at like, okay, how flexible can I be in my tax spend down strategies, and really be planning for having secondary plans for those unexpected circumstances and the required minimum distributions. Those are two big things that come into play.
So we had a question on the previous slide about the types of accounts that are tax deferred. Can you go over the types of accounts?
Yeah, so the types of accounts are going to be, your qualified plans, your IRAs, 401ks, 403bs, anything where, when you're looking at a salary reduction, right? So I made $100,000 and I put $10,000 into this employee sponsored plan or $6,000 into this individual retirement account, and it reduced my taxability by that amount. Really, you're just saying, hey, I made this money, but I'm putting it away. And so when you pull that out, it's taxed as if it's income.
All right.
And there's, oh, go ahead.
We did have another question, but keep on going if you wanted to finish your thought there.
I was just gonna, I was gonna maybe dive a little bit too much into the weeds, where I was gonna say, like, also you can, via real estate or other, you can do what's called a 1031 exchange, where you take gains from a particular asset, like real estate, and you roll those gains into another project that also creates a tax bubble or a tax bomb that, if not dealt with, if you keep kicking the can down the road, eventually there's no more road, right? And so you want to give yourself as much runway and as much planning to deal with that while you can.
All right. The other question is, how does going up to a high tax bracket affect? Obviously, you pay more taxes, but does it affect other things in your life?
It can affect other things in your life, and we will actually. We're getting there in the presentation. So part
okay,
of that,
well, hold on to that question.
Yeah. So we'll hold on to that one. So and this is the one that I already teased, so I'll only spend a few seconds on it. But the other thing is inheritance taxes. Many people think, oh, this is like an ultra wealthy thing, right? Like I'm not going to have that issue. Well, the inheritance tax is, a 40% tax on your estate, and who it's applied to has changed from time to time, right? It could apply to, like, at the recording of this, $12 million per person, or for couples, $24 million, $25 million of a total net worth of their estate. Me personally, I think this is going to look very different and probably be applied to more people in the next 10 years, because I think there's going to be, there's already talks of states implementing their own inheritance tax. The lovely state of California has even gone as far as putting it down. It hasn't passed yet. Of saying, hey, any estate over $3.5 million, for anyone who's familiar with the Bay Area, it's like, oh, sweet, a 2-bedroom house, right? Like that's there's your $3.5 million right there. So I think this will become a bigger play. And again, this is not something where I'd say, like, hey, you should be doing a deep dive in inheritance taxes and how to plan for it. You should be doing a brief overview with, here's what they are and the tools that are used to get around it. If it comes into play, we know what to do, right? Make sure you have someone on your team that knows what to do. So, and the last bullet point there too is for your qualified plans. And this is another thing that I think does need to, regardless of your net worth or income status, your qualified plans do not get what's called the step up in basis when inherited. And so, if I buy a house for $200,000 and over the next 40 years it all of a sudden is worth $800,000, if I were to sell that house, if it were an investment property and I were to sell that house, I would pay capital gains on the tax, or I'd defer it and create a tax bump. If I were to pass away, then whoever inherits the house gets to say, okay, it was purchased at $200,000. It's now worth $800,000. If Mark sells it, he pays capital gains on the growth. I inherited it, so my cost basis is $800,000. I could sell it tomorrow and pay zero taxes, right?
If you sold it for like exactly.
If you sold it for exactly $800,000, yes.
Okay, all right.
But
it's different for qualified accounts like 401k.
Different for qualified accounts. Qualified accounts, you get an inherited account. You have to spend it within a certain amount of time. The inherited IRAs, the rules have changed recently. At most you can liquidate it. The most you can stretch it out is 10 years, maybe. has to be spent, right? And it's not, hey, you inherited a $500,000 IRA, your tax basis is 500,000. It's, oh, well, if you pull 100,000 out every year for the next 10 years, it's going to be taxed at ordinary income, right? And so that's also something to be mindful of with inheritance planning is, hey, how can we best leverage this to get it to our heirs at lowest tax implications as possible. So spent more than a few seconds on that slide.
That's okay. I think that's important that people know.
Yeah. Yes. So your big variables here are going to be, obviously, and this is just kind of recapping some of this before, if anyone's depressed, hold on, we're getting to the strategy part, right? I don't want this to be like, man, I'm just gonna live super, they can't catch me if I'm broke, right? That's not the best wealth management. That's not growing your asset, your wealth like a business. But the big variable is the tax man. It's the IRS. It's your, if you have state taxes, you can include them in the party. But if you have a 401k or qualified plan worth $4 million, the rate at which you spend will dictate how much you're taxed. The rate at which they decide to tax you is also going to impact that, because they could say, okay, well, we're just going to raise taxes. Well, you still need your 120,000, so you got to spend more to net 120,000. And so you want to give yourself options for being flexible around those that big variable, right? There are other variables to include, but that's the big one. So your 4 focus points, and I hope everyone pulls out a calendar and says, awesome, Mark said to review this every spring and every fall. I'm going to mark it down on the calendar. No pun intended. It's the Mark rule. So every spring and every fall, you should be looking at these 4 main tax focus points, right? You got your ordinary income tax. That's, and we'll dive into that. Capital gains tax, any tax-free accounts or strategies, and then the queen piece on the chessboard, or whatever analogy you want to use for your big power player, is going to be that strategic conversion of taxability. Like, how can I take things that are taxed one way and get them taxed a different way? So, or just get taxed less. So ordinary income tax, like I mentioned, if you make $100,000, you put 10,000 in a qualified plan. So you're funding your qualified plan. That's going to be taxed at ordinary income. Your active passive income, that's going to be, I went and bought real estate. It's spinning me off some income. That's going to get taxed at ordinary income. I will say there are ways to be flexible with real estate investing. And so you do have depreciation and losses and certain things. So it fits the ordinary income tax from an income standpoint, but as an asset can be utilized in that strategic conversion of taxability.
Okay.
Earned wages, obviously, if you go get a job, you're going to pay your taxes like you are now. Any royalties or interest income, that's going to be taxed at ordinary income tax. Now, your tax deferred. Your capital gains tax. So your capital gains tax is going to be, okay, well, in that house scenario, I buy a piece of real estate for $200,000. It's an investment property. It grows to $800,000. I hold it for longer than 1 year. You're going to get taxed capital gains. Now, depending on your tax strategy and your income, you could be paying, there's some capital gains that is 0%, which is what I call the best long-term capital gains. There is 15% and there's 20%, right? Seeing where you land is, one way to do it. Strategically, trying to maximize your efficiency there is the better way. Now, that's if you hold a piece of, that's if you hold investments for longer than a year. If you're someone who flips houses, right, or is a day trader, or basically does not hold on to investments, they treat investments like hot potato, right? I get it, and I quickly try and toss it. That's going to be taxed at your highest your highest income bracket. So if you're at a 22% income bracket and you buy something, it grows by 10%, right? You're going to get charged on the, you're going to get charged your highest income bracket on that growth. So also for losses, if you have losses, you can carry those losses to offset gains. Probably shouldn't have mentioned that because that's a whole nother topic and a whole nother strategy. So we'll just move on from there.
All right, are we gonna, we already covered short term. There was a
Yep.
question here. What about dividends? Are they taxed at the same rate?
So dividends, your dividend income is going to get taxed at your long-term capital gains. And that's there's definitely some dividend strategies that I encourage people to look into when trying to map out what you're trying to accomplish with dividends. It always comes down to like, hey, is there an easier way to achieve this same goal? Sometimes there's not, or sometimes people are very dividend focused, right? And so it's like, okay, let's build a plan around, leveraging dividend, dividend income, or, bonds. Like some people say like, hey, I don't care that if I put 100 grand and buy $10,000 bonds, that the bonds are not really going to make me any money. It's the interest on them. I'm not going to say it's not a bad strategy. It's just one of those things where it's like we have to kind of shape the rest of the plan around how you want that to look.
Okay, so that's definitely an individual plan.
Yeah. Now your tax-free option is going to be, Roth IRAs, Roth 401ks. Basically, if you see Roth in front of it, that's going to be, and that's, here's the thing about it being quote unquote tax-free. It's not really tax-free. It's you paid your taxes already. So, you have $100,000, you pay all of your taxes, and then you fund the Roth plan. That's going to be tax-free when assuming you hold the funds in the account long enough, and pull it out at the appropriate time. There's age limits on that. Those also are not, if we're going to the RMD conversation, well, the whole focus point on the RMDs is the IRS saying, we have waited long enough, we need our money. Well, if you pull money from a tax-free account, they don't get any money, so there's no RMDs. And so that does become something where it's like, hey, this should, deferring taxes is awesome, but being able to control your tax bracket, and we'll get to that in the next slide, is, you're going to be saying thank you to past self when you go to retire. Cash value life insurance is another option that's been utilized for a tax-free asset. Muni bonds, which is basically, municipal bonds that if you live in a state and you buy municipal bonds for that state, they're tax-free as well. Typically low return, but I have definitely heard of examples where someone has like a multi-million-dollar exit and they put it all in muni bonds, and they're just like, I've got 0% taxes on any of my interest. I don't care if I'm making hardly any money. I'm making hardly any tax-free money, and it's all I need to live on. So I'm happy, right? So it's definitely there's a million different strategies out there. You just have to treat them appropriately and not assume they do one thing when they don't, right? And I'd never say like, oh, don't do that. It would just be like, okay, you can go down that path, but here's all the pros and cons of it. And if we can map it out and make it work, let's make it work. So now to the queen piece on the chessboard, the strategic conversion of taxability. This is going to be where you take things that were taxed one way and you create a spend down strategy to be flexible around tax brackets, right? Probably the most, the biggest one right now is Roth conversions, right? So for anyone who is unaware of what a Roth conversion is, that is when you take money that you put in a 401k or an IRA, and you said, let's say that you're at the 32% or the 22% tax bracket, and you're like, I don't want to pay taxes on this. I want to defer it and have it grow. So I'm going to put that in my 401k. Well, let's say you take a 6-month sabbatical, and or I have someone in my family who's on a long-term disability right now, and they're going to go back to work, but they just they're in a situation where they can't, and so their income is much lower. Well, that means that 32 or that 22% tax bracket they were in when they took that money and said, hey, Uncle Sam, you can't touch it, I'm putting it away, and you can touch it when I pull it out. Well, you can now work with your tax professional and say, like, oh my gosh, I'm going to be in 12% tax bracket. Like, hey, Uncle Sam, you can now tax me on that, right? Like I'll pay 12%, right? And you can we'll just use the $20,000 number, and you can say, like, hey, and it doesn't, there's no limit in what you can do, right? That's something you got to kind of pencil out with the tax and the math nerds. But you basically say, okay, well, this money is going to be taxed at ordinary income down the road. If I take we'll just say $25,000 and I convert that to a Roth, that's going to show as $25,000 worth of income, and it's going to charge you whatever your tax bracket is. And so if you do the math with your, again, the tax nerds and the math nerds, and you say, like, well, that's only going to cost me $1,200, and I still am not going to retire for another 15 years. My $25,000 is, for $1,200, I could make it $75,000 tax free, right? So that's one aspect of the tax conversion or the strategic conversion of taxability. Accelerated depreciation, right? For those who are building their wealth like a business owner, you take assets that, real estate or whatnot, and if you start building them up, we actually just had a scenario like this where someone was feeling a little tight financially, but they wanted to. I guess it's too complex to really get into, but essentially there's certain things that you can depreciate in year one, right? So you buy an asset, everything depreciates at a certain schedule, and they had never heard of taking all of their, all the depreciation that they could in year one. And so what that did was it basically opened up a bunch of capital that they could then go deploy in other tax favorable assets, right? Cost seg study, that's another, it's another one that we did have recently where someone was like, hey, I'm, my properties are, this stands for cost segregation, which basically is a more broad version of the accelerated depreciation. That's where basically you get a breakdown of all of your assets, your hard assets, and say, like, okay, well, instead of just taking it on a flat line depreciation, taking all of it and averaging it out, we're going to identify exactly what can be taken in what schedule. And it's a way to recapture some depreciation early on. Very, very important that a CPA is involved in basically maxing out that efficiency, right? You really want to make sure that for any depreciation that you are capturing early, you're able to deploy that and use it appropriately, right? Charitable planning, another huge topic where I did a webinar with Advice Chaser with Ed Cotney on this very topic, where some people don't realize you can make more money through charitable planning. You can sell assets. You can sell. This is very big in the inheritance planning. It's very big in the qualified plans. You can actually make more money and get money out of your estate and not subject to estate taxes through charitable planning. Very, very useful knowledge to know. Reinvestment of gains with the return of capital. That's another complex strategy that basically says, hey, I'm going to invest in this thing, and it's whether you're working with a credit investor group, right, or you're working with a real estate syndication group or whatnot, and they're basically able to say, hey, the gains you have in let's just say it's $100,000. They say the $100,000 you invest grows to $150,000, and they say we can return the principal back to you and keep the gains growing. That's a great way to That's a great way to get your get your original investment back. And when you get original investment back, it's not taxed. So if you have, all of a sudden you have an influx of cash of not taxed money, you can maybe do one of those Roth conversions or implement various strategies. And then it also gives you the ability to go and say, okay, well, what can I now put in place to eventually offset the gain when I take that 50,000 that grew and whatever grows from there, right? So again, these are very, I'm trying to broadly describe, these things because it can get very complex. It requires a good team. A good team is going to be, needed for viewing this. But I would say if you're not at least looking at these 4 focus points twice a year, then start doing that now, right? Start looking at what is, this year, what is ordinary income tax and what assets am I building that are going to be taxed with ordinary income tax? What assets today are capital gains, long-term capital gains, and what assets am I building that are eventually going to be long-term capital gains? What is tax-free? What is eventually going to be tax-free? And then, there's that last piece, the conversion of taxability. It's not going to be like you doing something every year and just radically changing your life. It's going to be identifying the direction things are going, how you're growing your balance sheet, and those few times in your life where you can really make some impactful difference by, I'll kind of, this should be broad enough of a example to not pinpoint anything specific, but let's say you are selling an asset that has a large capital gain tax. Well, what if through extensive planning, you also identified something that had a high degree of accelerated depreciation, and you were able to sell one asset, and instead of defer the taxes, which creates that tax bomb, invest in something that gives you accelerated depreciation year 1 to offset that, that taxable event. And then you get your principal back from that, and the gains keep growing. That is a large focal point in your plan where you, with proper planning, would have taken these things that are taxed in very different ways, aligned them just right, grew your wealth like a business would, like a business owner would, like an entrepreneur would, and you have huge, you're just using the same tax code everyone else has, right? It's just you're using it smarter than 99% of people out there.
It's an interesting strategy. I just think about like if you have a large purchase that you have to make anyway, and offsetting it with that's an interesting strategy.
Yeah, and again, it's without getting too detailed, because there's lots of nuances there, but and you might not be at a point where you need all the nuances, but you at least need to be having that twice a year conversation about like, okay, well, how do I get to that point? How do I again, it goes back to building wealth like a business owner. So everyone obviously going back to their calendar, and they've marked it for the spring and the fall, and they're basically writing down these notes now, saying like, okay, well, here's my 4-step thing I've got to do. I've got to identify the various assets and how they're going to be taxed in the future. Very easy to do. I need to then prioritize the taxable assets that I either am severely lacking or just missing that are going to be useful in the future, right? I see this a lot where I basically show people like, hey, you're doing a great job saving. You're just only saving in one particular way, right? So we just got to focus on, not saving more money, just shifting the savings a little bit. Then you got to just start creating that plan for how do I start incorporating those other things that I'm missing and building onto the tax pieces I currently have, right? I'm not an all or nothing guy. I'm not a like, hey, never save in a 401k. I know people who say that, or never buy real estate. I know people who say that. I'm not a never, I'm not a always or nothing. Okay, well, if this works and it's, we just have to find some complementary things to go alongside of it. And and then, learn how you can start making, how you make those shifts, right? When you identify, here's what I have, here's what I don't have, here's how I can start building, right? Like, and incorporating the things I don't have into what I have. And then here are the particular strategies, whether it's how I spend the money, how I sell the asset, how I alter my lifestyle, whatever you got to do to get that strategic conversion of taxability in place. Again, to that person who asked at the very beginning, how young is too young? As the longer the runway, the better off you are, right? So, and kind of, for anyone who might be thinking like, okay, well, I don't really see anything on the horizon, just so you know, that there's typically only a few focal points at which like everything comes together and you execute something complex. So a lot of it is boring routine. Again, spring, fall, identify, write down, plan, and then you'll eventually get to that point where it's like, okay, in the next 2 years, this is when we have this coming up. So we got to start planning, we've got to start putting those pieces in motion today. So.
Very interesting, Mark. We do have some questions that have come up. So I'm going to go ahead and talk about them, and then we will invite anyone else who has questions during our question and answers portion of the webinar that they're welcome to put those in the chat. So here's the first one. How often can you do a Roth conversion?
As many times as you want, right? I mean, you can do one every year. Roth IRAs have a contribution limit. So if you make over a certain amount, you can't put money into a Roth. That does not apply to Roth 401ks, and it does not apply to Roth conversions. So if you make $500,000 a year, you can still do a Roth conversion. And your Roth 401k has a maximum amount that you can put in it. Your Roth IRA has a maximum amount you can put in it. A Roth conversion, you can convert $80,000 if you want.
Interesting. Can you, maybe this is a question that goes right to that, what you mentioned. Can you explain what a backdoor Roth conversion is?
Yeah, so I mean, that's basically, so for those people who do get phased out of being able to contribute to a Roth, the backdoor Roth is basically just, so theoretically, if I make over a certain amount, I can't contribute to a Roth IRA. And so I'm going to, or I contribute, the 20,500 to my Roth 401k, but my employer put his contributions in and they all went to pre-tax. And let's say I'm dead set on, I'm going to get everything, Roth all the way. Well, you can say, okay, well, I'm going to fund a traditional IRA, right? I'm going to put my 6,000 in there, and then just in the same, and then I'm just going to convert it to a Roth, right? So, believe it or not, in 80,000 pages of tax code, there are some weird ways, like some weird things like that, where it's like, so I can't contribute to a Roth IRA, but I can contribute to an IRA and convert it to a Roth. Yes, it makes no sense, but that's how it is. And so that's, what you hear people doing. Or they'll say, hey, if their 401k allows for Roth conversions, they'll say, I put my 20,500 in as a Roth. My employer put their 5,000 in as pre-tax. I want to convert their 5,000 over to a Roth. So just be careful, because, again, if you're like, sweet, Mark said Roths are awesome, I want a Roth, right? Like, and you convert 300,000 over, you're going to show an extra 300,000 income next year, and then you're going to have a tax bill due like very soon. So
there are tax implications to any Roth conversion.
With much counsel, proceed forward. With much counsel, proceed forward.
Okay. Okay, you talked a little bit about having a team help you with these kind of tax strategies. Can you talk about who should be on that team?
Yeah, so a CPA or a CPA is they're the tax nerds with the pocket. Anyone with a pocket protector, trust that guy, right? because if they're filing your taxes and they see any red flags, like they're gonna notify you. A wealth manager who is tax focused, right, is also key there, because if wealth manager is again focusing on the sugar of the financial statement and saying like, hey, you made $50,000, and not really looking at the rest, right, and not looking at the other types of assets. Definitely get someone who's having routine tax checkups, the spring and fall, and making sure that they're aware of your balance sheet outside of investments, because that could play a role in that. And the other thing, not to elaborate on this topic too much, but the other thing is you can, with proper tax planning, if you're able to say like, hey, I need $120,000 in retirement, or $200,000 in retirement. Well, if you're able to say, okay, well, I worked with my CPA and my tax focused advisor to where I'm taking as much as I can out of my capital gains tax to just fill up that 0% capital gains tax bucket.
Mm-hmm.
I'm taking as much as I can out of my Roth to then fill up a little bit there. I'm taking some out of my Social Security, which your Social Security is taxed differently depending on how much ordinary income you show. You could end up in a situation where, and then after all that, taking money out of your taxable account, you could end up in a situation where it's like, sweet, I need $200,000. I only really pulled like 50 out of my taxable account. It's like, sweet, in retirement, do as many, maybe start doing your Roth conversions then, right? Maybe say, hey, I'm 60, but I know when I'm 73, I'm going to want more Roth money. Let me do the math calculation and convert as much as I can over this next 12 years. So it doesn't have to be something you do just in your working years. You can absolutely incorporate it in your retirement plan as well.
Very cool. Well, that's about all the time we have for questions. I would tell people if they do have a question we didn't get to, and that is something that with such a large audience, sometimes we don't get to those. So go ahead and put that in the chat while I'm doing the outro, and we're happy to reach out to you after the event to make sure that gets addressed. On behalf of Advice Chaser, we want to thank our speaker and for the organizations that have worked with us to bring you this webinar today. Thank you so much for attending, and look for an email soon with a link to the replay of this event. And you're welcome to share that event with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.
Thanks, everyone.